Contracts for difference, or CFDs, are an agreement between two parties to exchange the difference between the opening value and closing value of a financial instrument or security. So what does this mean? A CFD is a derivative that lets an investor get exposure to a security's price movement without actually owning the underlying security. For example, an investor can gain exposure to a share that is traded on the ASX at a price of, let's say, $20 for as little as $1 by purchasing a CFD derived from that share. If the share price rises by 50 cents, the value of the share goes to $20.50. However, the value of the CFD would increase to $1.50. On the other hand, if the share price falls by 50 cents, the value of the share price would go to $19.50, and therefore the value of the CFD would now fall from $1 to 50 cents. Therefore, for a fraction of the cost of a share, an investor can experience the full effect of a price change. In the example we have used, the share price moved just 2.5%, but this equated to a 50% change in the value of a CFD. CFDs on equities available on listed markets in Australia, US, Japan, United Kingdom, Hong Kong and Singapore. CFDs are traded over the counter, OTC, between two parties where one of the parties is usually a broker. Being a derivative, a CFD is derived from an underlying security. For example, a CFD on BHP is derived from BHP shares and rises and falls in price by the same amount as the underlying BHP shares. For a fraction of the underlying share price, an investor can take a long position. They buy the CFD with a view from profiting from a share price rise, or they can take a short position where they sell the CFD with a view for profiting from a share price fall. Rather than paying the full value of the underlying share, an investor places a cash deposit in their account. This is known as margin. This is used as collateral for the position being taken. The margin requirement varies according to the underlying share being purchased or sold. Unlike other equity derivatives such as futures and options, CFDs do not have an expiry date. Therefore, as long as the investor has sufficient margin in the account to cover price movements and interest costs, a CFD position can be held indefinitely. CFDs offer an investor or trader an alternative means of trading the share market to benefit from short-term price fluctuations, or as a means of hedging against adverse price movements.